Thanks for tuning in. Today we're here with John Devine, Managing Director of OTC Trading at BlockFills, and also a recent author of Bitcoin Options. Is that correct, John?
That's right. I got the book right here for you, Mike.
I love it.
Bitcoin Options.
Look at that.
There we go.
That's nice.
Thank you very much.
Good stuff.
Awesome. John, we're looking forward to chatting with you today. Looking forward to this for a while. Let's start off. Take us back. How'd you get into the crypto markets?
Yeah, I like starting like this just to give some foundation to what we're going to get into. I began my trading career right out of grad school. I got hired to clerk on a precious metals market making desk at the Chicago Mercantile Exchange. And that experience, I did that for a number of years, and that experience kind of set up everything else I've done in financial markets, including what I've done in crypto. I'll point out, making markets in gold, silver, copper, platinum, palladium. It just opened up my eyes to the importance of liquidity and how liquidity is just the foundation for market structure and really all the strategies that can be built into markets. What we were doing there was providing liquidity in really illiquid calendar spread markets. And we were, pricing the entire forward curve, which we'll talk about for Bitcoin. And that journey took me, it took me to San Juan, Puerto Rico, actually, after a couple of years trading in Chicago. And when I came down to San Juan, I became inundated with the Bitcoin community. I was just blown away by the brain power that was building on the protocol, but also the asset managers, hedge fund traders, prop traders, and just the high net worths that were managing their own personal accounts. I was just fascinated by the Bitcoin market.
When is this, by the way, just for some perspective?
Yeah, that's 2018. Mm-hmm. So we were in the middle of a major Bitcoin bear market at the time. But that set me up to join a hedge fund that was focused only on Bitcoin and Ethereum and the Bitcoin Ether spread. And that allowed me to really wrap my head around the ecosystem, so to speak. And that led me to, not too much longer after that led me to BlockFills. And BlockFills was a major liquidity provider to me when I was trading at the hedge fund. And it was early enough in Bitcoin, Ethereum, markets where derivatives were kind of just coming on. They had perpetual swap trading that was already kind of a mainstay in crypto markets, but the options and the dated futures, and then of course the structured products that follow that, had really just been at their infancy. So I stepped into BlockFills, call that 2020, and I've been building Bitcoin options markets, structured product markets, and lend borrow, along with, of course, dark pooled spot for the past 5 years here at BlockFills.
Yeah,
that's awesome.
Awesome. Let's start with liquidity. So you mentioned you learned about liquidity, the importance of it. Let's start with that. Kind of what jumps out at you? Like tell us about the importance of liquidity from your perspective.
This is the major focus of any market operator. When you come into a market, the first question is, how deep is the order book? And, what's the notional volume that's transacting on a daily basis in this marketplace? How can I position size orders and size execution effectively and efficiently? Are there any gaps in liquidity that I can fill in and spread off as like an arbitrage opportunity, which there were plenty of those, just a couple of years ago in Bitcoin. Those have kind of been found out, so to speak. So that's where I start. And when you think about Bitcoin and you think about institutional execution into Bitcoin, oftentimes those conversations begin with dark pools. And so I'll make a distinction between what we would say like a lit exchange, which many people would be familiar with, the likes of Coinbase or Kraken, or I could go down that list. Binance, of course. Then we also have these things called dark pools. And dark pools are non-public liquidity sources, and they're generally constructed for professional traders and asset managers to execute usually size orders, and what I mean by that is, the notional value of that order is magnitudes larger than what's available on the best bid or best offer at a public exchange. And there's some advantages to these dark pool executions. Number one, these bots that are scouring public order books, they can't really sniff out the order, and a lot of times public exchange order books get front run, or people develop stop strategies around big resting orders, etc. Dark pools allow you to kind of get around that public view of an order book. So in terms of liquidity, what we've seen in the past, I'll call it 5 years, is a massive inflow of professional market makers that we would be very accustomed to in my old world in precious metals, or of course in stocks and other commodities. Those same market making firms have come into crypto in the past 5-7 years. So along that route, liquidity has just beefed up, and dark pool execution has, really a bright light has been shining on the accessibility of these dark pool markets. BlockFills, of course, is bringing that to asset managers and professional traders. Of course, that's spot. And then you need to think about options, liquidity, and dated futures contract liquidity, and what that looks like, and even structured product liquidity.
Talk to us a little bit more about dark pools. Like what, or is this, kind of just give us the full picture for those that are listening.
Yeah, where are they at, the different aspects of that. Yeah.
Yeah, I think the number one thing to take away from dark pool execution is just referencing against the alternative, which is the public order book, as we've covered. And if you are seeking to deploy strategies that are sensitive to, let's say you rest orders in an order book and they're size orders, traders will come in and trade around your large resting order. So a dark pool removes that basically, and allows sophisticated market participants to execute in a fashion that is not being scouted out, I'll say, by high frequency trading bots or these stop programs that work around large orders.
And is this like, does BlockFills have their own dark pool, and then like other brokers will have their own dark pools? That kind of how?
Yeah. So BlockFills runs one of the largest, if not the largest, dark pool for Bitcoin. There are a few other dark pools in the ecosystem as well.
Cool. Your massive trading activity then across the ecosystem to avoid some of that.
Definitely, and I shouldn't just pinpoint Bitcoin. I mean, we have constructed dark pools for a number of the most demanded digital assets from professional traders and fund managers.
Got it. Okay, and then you were about to get into options liquidity.
Yeah, so that's the next frontier. Once spot, and I will say that liquidity issues in spot were largely solved over the past couple of years. As this, you remember back in 2020, 2021, the big saying in Bitcoin was the institutions are coming. The institutions are coming. That's what everyone was talking about. It was around the time that Paul Tudor Jones stepped into the market, and some other big names from Wall Street.
Right.
And the hesitation largely, once you wrap your head around Bitcoin and you say to yourself as an asset manager, I want to be involved in this market. The next step is, what's the liquidity and how do I get orders done? And so I think that the market took a while to be able to serve those types of players, but obviously Bitcoin has become institutionalized in the past few years, and that was largely due to the build out of the tech stacks required to provide liquidity, all the pieces that go into building dark pools. And so options became the forefront. And, I remember when I first started trading Bitcoin options, they certainly didn't have daily options markets, which we now have. There was barely a weekly listing. It was mostly, liquidity was focused on quarterly options expirations. And that's how you know you're dealing with an illiquid market. When options are only tradable on a quarterly basis, it's because liquidity takes time to build out. Now you can trade overnight options. You can trade weeklies, monthlies, obviously the quarterlies. So that was where I found particular interest, just from my background as a market maker and liquidity provider in the precious metals, was what a fascinating problem to solve. And, building liquidity for options, and then, how that effort can facilitate large asset managers that we're now all accustomed to being participants in Bitcoin. But, before liquidity built out, the goal was how do we serve these participants best? And that's been the objective, and it continues to be so.
Very cool.
So over the last, 5-7 years, you've seen more liquidity come to the space. Any other notable changes that you've seen in terms of, market participants, market structures?
One of the coolest things to talk about in terms of where has Bitcoin come from over the past, call it like 5 or 7 years. So, number one, the first thing I can point out is, and I'll go back to options, implied volatility. 5 years ago, Bitcoin implied volatility was north of 100%. And that's, that's an incredible amount of implied volatility for any asset, let alone an asset that was going to become a mainstay on the global stage of investment baskets. What I mean by implied volatility, the definition is it's a one standard deviation expected move for the underlying asset on an annualized basis. So if you think about that definition, you think about Bitcoin was 100 vol. I mean, wow, right? This thing moves. And of course you can just go look at a chart and say, yeah, wow, that thing moves. But that's the textbook definition of what I'm referring to. And then, the other fascinating thing that's changed is something we call the forward curve. So I'll step away from options for a second, and I'll talk about dated futures contracts. And, with all commodity markets, there's a spot market, Bitcoin to be bought or sold and delivered and settled today. That's the spot market. But then you also have forward contracts or futures contracts. And I'll give you an example. Right now, I'm talking to you and it's February 18th, 2025. There is a February 28th, a February full month futures contract. There is a March price for Bitcoin. There's an April, a May, a June, a July, August, all the way out, right? And really our forward curve now goes out 2 years. And what we've seen on that is, number one, liquidity has built out. These contracts were extremely liquid just a few years ago. But number two is the spread that the futures contracts trade at over spot. So easy example is, as we speak this second, Bitcoin is trading at $95,500 spot. The March 28th, 2025 futures contract, which is the next quarterly expiration, that's trading at 96,175. So you can see that spread. Futures contracts generally trade over spot. We call that a contango marketplace, where forward delivery prices are trading above spot delivery prices. The inverse scenario there, if we're forward or futures contracts to trade below spot prices, we would call that a backwardated market. A market that's in backwardation. And so what we've seen over the past few years in what I'll call forward curve term structure is a tightening of that basis, or a tightening of that spread between spot and forward prices. That's largely driven by liquidity. There simply was a lag.
The market saying in the next month it's only going to go up a little bit versus, maybe back in the past it would have been a lot more.
Yeah, yes, like just throwing round numbers out. If spot was trading at 95,500 today, and right now the March futures contract is trading at 96,100, 96,200. A few years ago, that March contract would have been trading a few $1,000s over spot on a relative basis.
Makes sense.
Very cool.
Yeah. And so like what that is, that's a very basic hedge fund strategy that is comprised of two legs. And the legs are, number one, you buy spot Bitcoin, and then you immediately sell a futures contract or a forward contract. We call that a basis trade. I talk about that in the book. But that's a statistical arbitrage approach to capturing yield. And also it's a liquidity provision strategy as well. The market is demanding offers or sellers in the forward market, and they will pay a spread for that demand. And asset managers can come in and fulfill that demand by buying spot and then selling forward. Yeah. And that's a function of a demand for leverage exposure generally.
Yeah, that makes sense. I kind of answered the question, but I was just thinking, what the big question people ask, well, why have options become important relative to Bitcoin and Ethereum, right? You kind of answered part of it, but maybe expand on that thought process there.
Yeah. So, when I think about Bitcoin, just fundamentally, Bitcoin is a mechanism to store and transfer human time, energy, and effort. It's an energy transfer mechanism, energy storage and transfer mechanism. Options contracts are a risk transfer mechanism. Okay. And so if you can figure out how to combine the two, energy transfer and risk transfer, there becomes a very interesting approach to how you can structure a portfolio, how you can initiate a position in this market. For those who are just starting to buy Bitcoin, you can think about using options contracts to optimize that initial execution. And I can get into that a little bit. And then also risk mitigation. That's the point of, that's why options contracts were invented, to help commodity producers and consumers manage risk. So that's why options are becoming extremely important. And you're seeing that. I won't get too deep on the ETF because I don't really handle the ETF. I handle spot exposure and spot-based derivatives. But the ETF, one of the first things they wanted to do, the BlackRocks of the world and all the other players who launched an ETF on Bitcoin, is they applied to have options trade on the ETF. And they all are very familiar with why that's an advantageous play. And we saw options contracts get approved for Bitcoin ETFs last year, or 2024, I should say. So yes, that's why. And I can talk strat a little bit as to how you can mitigate some risk with options. If you'd like to get into that.
Definitely get into that for sure. Let's talk about who's using options. So obviously, market participants, like we've been talking about here, risk management. You brought up things like energy storage. That kind of makes me think like, obviously perfect product for miners. Are there other folks in the space besides financial actors that are using these options?
Miners is the obvious play. Miners, they have typically the way that they're structured is they are locking in a cost of electricity as the major input to mining Bitcoin. Mm-hmm. So if you have your input cost fixed, or you understand at least roughly what your input costs are, the variable in a mining operation becomes the price of the asset you're producing, which is Bitcoin, or the price of the asset that you're mining, Bitcoin. And so now Bitcoin miners can utilize options contracts to secure, or to complete the loop in a sense, lock in their electricity costs and then lock in forward sale prices of Bitcoin when the market allows them to capture a price that provides a margin that is sufficient to the company.
Yeah.
That's the pure play in Bitcoin. The pure play for options anyway, is the producer, I'll say in quotes, of the asset, the miner, who is receiving a block reward for validating transactions on the network. They are the obvious player who can utilize options to mitigate and transfer risk and run a business that's focused on margins instead of speculating on where the price of Bitcoin may or may not be in the future. The other market participants that come into play here would be hedge fund managers, Bitcoin whales, and proprietary traders.
Yeah.
Makes sense.
Before we jump into strategies, let's talk about your book. So what was your inspiration for writing it?
Yeah, that's a good question. And I get asked that, and I never really quite have an answer that fully encapsulates where my mental state was when I began that undertaking. I think I'll point out that I've written 2 other books. I wrote a book on the introduction to futures markets, and that's available on my website, johndevine.com. I also wrote a book called Building Statistical Arbitrage Trading Strategies. That's a mouthful. There's not a very big market for that book, quite frankly, but it's also available on my website. And those 2 are for free. The Bitcoin options book, I charge $18 on Amazon. And the reason I do is this book took a lot out of me, just to be quite frank about it. The reason I decided to write the book was really based on these types of conversations. I had the opportunity to be involved in these markets from a very early standpoint, and the amount of people that ask questions, even at the most basic levels to extremely sophisticated questions, they just kept coming in. And I said to myself, you know what? There's a demand here in this market for knowledge. And the book is educational. There is no financial advice in the book. It's an educational book that explores the fundamentals of options. I also talk about, my journey into Bitcoin and why Bitcoin matters to this world and all that. And that's how I start the book. But the real inspiration was to satisfy the demand for knowledge, which anyone who's in markets loves to learn. I mean, you gotta love to learn if you're going to be active in any market, but especially Bitcoin, given how we are still technically in an adoption phase of this commodity.
Yeah.
And so took me a year to write the book, took me 4 months to edit it. It was a journey, I'll tell you that.
I bet. Yeah.
Yeah.
That's pretty exciting, and obviously a big feat. So congratulations to you on that. I'm curious too, but one question, obviously, you think about being the futures market, when they created the derivatives market for Bitcoin, for crypto, what's your thought first? I mean, this is here to stay. I'm just kind of curious. And speaking to others, when that happened in this space, it definitely was a defining moment, I think, for a lot of people.
Yeah. So I started talking with other market participants about Bitcoin options in, call it 2018, early 2019, before there really was a market. I mean, it was trading a little bit over the counter, and there was a big public exchange that kind of started doing it. But when I started thinking about options seriously, my first instinct was, really, is there really going to be an entire derivatives complex on Bitcoin? We weren't even talking really about Ethereum options. We were, but Bitcoin was my focus at that time.
Right.
And it took me a while to wrap my head around that, my gosh, this is going to be just like any other commodity market. We're going to see volatility compress as more sophisticated players come in. We're going to see not demand for speculation, but demand for risk management via options. There's going to be a professional approach to this marketplace. And my gosh, let's go build it. But I wasn't quite convinced. I'll say that,
Yeah.
Even just 5 or 6 years ago that this complex would develop. But, as COVID accelerated everything in digital assets, and really even some stuff in traditional markets, in terms of retail participation, et cetera.
Yeah.
But the COVID era just accelerated the thirst for knowledge, the thirst for the ability to execute, and that was probably the catalyst on why the curve accelerated in terms of derivatives adoption.
Let's get into some strategies. So you want to lay out a couple strategies for us before you dive into them?
Yeah. So, in the book, and I got to preface and say, of course, this is just educational information. and do your own research and all that stuff, and consult with your financial advisor, etc.
Disclaimers.
Yes, but I love to talk strat, and this is what I love to do. So in the book, I talk about a number of different strategies, but for this, I can start at the most basic level for options, that is. And the most fundamental strategy you can deploy in options contracts is when you own an asset like Bitcoin, you can sell covered calls against that asset and generate cash flow either in dollars or in Bitcoin. And when I talk Bitcoin, of course, I'm talking a multitude of digital asset markets at this point, but I'll stick on Bitcoin. So I'll give you an example. Bitcoin's trading at 95,500. It's February 18th, 2025. I can go look at the options market and say, what's the 20 delta option that expires on March 28th, 2025? And before I continue, I'll define what I mean by delta. Delta, or there's a few definitions, but the one I'm using here is the percent likelihood that an option expires in the money. So when I look at a 20 delta option, at the moment in time I'm speaking, the market is pricing a 20% probability that this option will expire in the money. So what does that mean? If I look at my sheet, I will identify that the 114,000 strike call option is 20 delta, and I'm talking for March 28th expiry. So a call option is the right to own an asset at a predetermined price, the strike price, during a predetermined time, the expiration date. So we have already defined our expiration date. That's March 28th, 2025. We're defining our strike price as the 114,000 strike because that is roughly 20 delta as we speak, meaning 20% probability that Bitcoin trades above 114,000 on March 28th, 2025. Okay, so then I got to think to myself, if a call option is the right to own an asset at the strike price on the expiration date, what does it mean if I sell the option? Okay, and if the buyer of the option has the right to own my Bitcoin at the strike price on the expiry, that means as the seller of a call option, I have an obligation to sell my asset at that strike price on the expiration date were the option to be in the money. Okay, so Bitcoin 95,500. I'm going to go sell the 114,000 strike call option. By the way, Bitcoin spot prices have never traded to 114,000, although the probabilities are very real that it does. But I can create cash flow against this asset that is trading up and down every day. So I sell that call option. I now obligate myself to sell Bitcoin at 114,000 on March 28th, and I can collect a premium. And, without getting into hard numbers, you can think about returns, annualized returns around or north of 20% for these types of options. And annualized returns are a function really of implied volatility. So options are more expensive when implied volatility is higher, and thus potential for a higher annualized rate of return when you sell options. And then if implied volatility is lower, which we are in a low implied volatility environment currently, then those annualized yields also compress. But that's where I would start with strat. And covered calls are extremely common approach to multitude of assets. Stock, all tradable assets basically. So this is taking a very tried and true approach to monetizing an asset that you own and applying it to Bitcoin.
Very cool.
Got it. So you got the covered call. What's next?
Yeah. So now I can build on the covered call. Sticking with the exact same scenario, when I sell that 114,000 strike call option, I'm going to collect the premium yield as we've discussed. And I can either put that yield, that premium in my pocket, either US dollars or Bitcoin, in my pocket and just generate income from Bitcoin that I hold, or I can take that premium and I can use it to go buy insurance or protection that grants me the right to sell my Bitcoin at a predetermined price at a predetermined expiration date. I'm referring to put options. When you buy a put option, you have the right to sell the asset at the strike price. So effectively, I can lock in a floor. I can lock in a price that I know for sure I can sell my Bitcoin at by purchasing a put option. And in this scenario, I'm paying for that protection with the premium yield I have achieved and have been credited from selling the call. So, roughly you sell that 114,000 strike call option, you can go buy the 83,000 strike put at zero cost. Now I want to think about this as a net portfolio. I'm long, let's say, one Bitcoin. Mm-hmm. I sell the 114,000 strike call, which obligates me to sell my one Bitcoin at 114,000 were Bitcoin to be above that price on the expiration date. And I have purchased the right to sell my Bitcoin at 83,000. Okay. So when you talk about an asset that moves violently up and down like Bitcoin, selling upside to pay for insurance becomes extremely interesting, especially for holders of Bitcoin that are willing to, I'll say, sacrifice the dream that Bitcoin is going to appreciate by more than 30% in a month or in 37 days to be exact. Yeah. So a lot of Bitcoiners often have problems selling upside because we all have heard of the God candles, and you can go look at the chart and you can see these God candles. And what I mean by that is some months in the past 14 years, Bitcoin has exploded. And if you are to the upside, and if you are short that call option, you are sacrificing potential gains above the strike price that you've sold that call at. And I think that has been the biggest hesitation for people to start doing this strategy. But for investors that are more accustomed to less volatile assets, this strategy has seemingly been a no-brainer in some senses to deploy.
Yeah. Yeah, that's really interesting. Obviously, so less volatility in different asset classes. Is there any other nuances relative to Bitcoin options that are maybe more nuanced that people should think about?
Yeah, the nuance is the implied volatility. I mean, unless you are trading these leveraged ETFs, I don't even mean Bitcoin, although they now do have leveraged Bitcoin ETFs. Right. It's hard to find assets that have such high implied volatility. So, you talk to traders that are coming from the gold market, for example, and they will say, wait, what did you say the implied volatility was? And that's how elevated it is in Bitcoin. Yeah. So that's the big nuance. And what we're getting at here is we are finding a way to monetize Bitcoin volatility. And Michael Saylor famously said, Bitcoin's volatility it's a benefit to the asset. I'm going to chop up his quote now. I just had it in my mind. I'm going to chop it up. But anyway, Michael, he tweeted out about Bitcoin volatility and how that's a positive for the asset, not a negative. And we can see MicroStrategy is actually monetizing volatility in what they're doing. They're not doing it directly with vanilla options, but Michael is monetizing volatility. And he said it's a feature, not a bug. That was the quote.
So volatility comes with price discovery, as they say.
Yes.
Okay, so we've talked about cover calls, and what's the name of the second one?
I'll call that a zero cost collar.
Zero cost collar. Okay. Yeah. What do you got for us after this?
In my book, I call it the optimized HODL.
Okay.
Optimized HODL.
I like that.
Actually, before we move on, I have a question because I think you made an interesting point there. Where you mentioned, selling the dream by selling these calls forward. Is there, I forgot the terminology, but is there more puts being purchased than there are calls being sold because of this?
This is a good question. So I'll tackle the first part of it, and I like that you brought that up because this is really the name of the game. When you sell these, I call them out of the money options, these 20 delta options or 10 delta options in Bitcoin, it's sometimes interesting how expensive they are, and why. Why is there a buyer willing to pay a seemingly elevated price for these options that are, by definition, unlikely to be worth anything at expiration?
Yeah.
And the reason that there are buyers is because of these potential God candles. And what I will say, the dream that Bitcoin can rally 40, 50, 70, 100% in a month or in a quarter. And because this has happened in the past, people believe it can happen in the future. And I'm certainly not going to sit here and say that it can't, but it is a dream. And selling the dream is monetizing that implied volatility, which is only elevated because there is a chance that Bitcoin pops to the upside anytime, any moment, which is the fascinating thing about digital assets relative to a lot of other asset classes.
Yeah.
So that's the point on selling the dream. And then your question, are there more puts being bought than calls? And this is what I'm here to talk about. So this is we have a metric that we call Skew. And I talk about Skew in my book. And Skew measures the difference in implied volatility between two fixed strike or fixed vol assets or options contracts. So what I mean by that is, if I have a 20 delta call and I have a 20 delta put, is there a difference in implied volatility between those two options with the same expiration date? And we oftentimes do see a skew. And interestingly, in Bitcoin, call options are generally or typically more expensive than put options. And this goes back to the dream. Bitcoin market participants that are speculating for upside price appreciation. They're generally not speculating that Bitcoin's going to zero. So they go buy these call options. And there's more buyers of call options than there are buyers of put options. And that makes the skew swing towards calls. And calls are relatively more expensive than puts, usually. Okay. And that's an oddity when you cross-reference other commodity markets and stocks, definitely, where protection or put options trade at a premium over calls. That's the kind of the normal right. Market.
The protection's more desired than the upside.
Yeah. There's more demand to protect a portfolio than to speculate on upside appreciation in traditional markets. Digital assets, and of course, we are still very early. And not to play that word again, but we're early in these. These are new markets, so there is a lot of enthusiasm for potential. And that enthusiasm gets displayed through bids or buyers willing to come in and pay for upside options or perpetual swaps or futures contracts. Yeah. And that drives the curves. So, I'll give you an interesting example as to a scenario right now where that's not the case. So we have, as we speak, the Ethereum network is getting ready to go through an upgrade, a hard fork. Mm-hmm. And that hard fork is expected to happen at the end of March. So you can go look at the options curve and look at Skew for Ethereum options, and you will identify that, as we speak anyway, of course, these things change minute by minute, hour by hour, day by day. But as we're speaking, demand for puts for Ethereum, for ETH dollar, are bid over calls. We have it's a little bit of an interesting kink, and so that's a way to identify market sentiment without knowing about the Ethereum upgrade. An options trader or an options market participant would be able to identify that something's going on in Ethereum because the demand for protection is outpacing demand for upside exposure out to March 28th, 2025. Now, since there is a curve, we see that for April, May, June, July, August, all the way up to December, calls trade over puts for those further dated months. But for February options and for March options, as we're talking, puts are bid over calls.
That's quite interesting. Yeah,
it is. Yeah, we'll see. I guess we'll see what happens with everything there on Ethereum.
Yeah.
Yeah, well, that's a good. It's a good idea or a good thesis to now talk about the strategy we just covered, which that zero cost collar. If I was if an Ethereum holder could think about selling upside optionality on their underlying ETH holdings and buying insurance in case the Pectra upgrade has some type of issue or unforeseen circumstance or some type of catalyst to make the price of Ethereum go lower. Instead of selling your spot Ethereum, you can sell the upside calls, buy insurance, and structure your portfolio for that event.
Yeah. That's really cool.
Makes sense.
Yeah.
Any other kind of strategies people are using out there that are pretty common that you see?
Yeah, so let's keep rolling with puts here. Now that we've covered selling calls, cover calls, we've covered the zero cost collar, and now we've talked a little bit about Skew. The next strat I will get into is something we call a cash secured put. And this is an interesting strategy for a market participant that is initiating a new position in the underlying asset. So let's use Ethereum, since we've just covered that puts are now being bid. There's demand for protection out to March 28th. So Ethereum cash secured puts, when you buy a put option, as we've covered, you have the right to sell the underlying asset at the strike price on the expiration date. Okay. The seller of that put option has an obligation to buy the underlying asset at the strike price on the expiration date. Mm-hmm. They are obligated to buy the asset from the put owner who has the right to sell. The put buyer, the put owner, is going to pay for that protection, and the put seller is going to collect that premium yield. Just as the call seller collects premium from selling calls, the put seller collects premium from selling puts. In this scenario, let's say you want to put on an Ether position. You want to buy Ethereum. You think this Pectra upgrade is going to go great, and Ether's off to the races once we clear this narrative and this market event. If I look at Ethereum options, I can go look at the March 28th. We'll stick with the same expiration date. And I'll look at let's talk about the 15 delta option in between the 10 and the 20. Okay. The 15 delta option for Ethereum is basically the 2200 strike. Yeah. So if I sell that option, I can collect a premium, and that's going to annualize, again, rough numbers, north of 20%. I now become obligated to buy Ethereum at $2,200. And Ethereum, as we're talking, is trading at $2,600. Okay. Mm-hmm. So I love this strat, cash secured puts, for people or market participants who want to buy the asset anyway. Let's say they're thinking, oh, maybe I should just go buy Ethereum today at $2,600 and enter my position. If you read, after you read my book, or if you've been in markets, you would say, or I could sell a put option, collect premium, and obligate myself to own an asset that I want to own anyway. Yeah.
So I actually really like that one. So just summarize that again for us. So it's basically, the idea is I want to buy Ethereum. might as well buy it at $2,200. So I'm going to sell these puts, be obligated to purchase them at that time. And you basically like, how do you lose in that scenario?
Yeah. So when you sell the put option, you are obligated to own the asset at the strike price on the expiration date. In this case, the strike price is $2,200 and the expiration date is March 28th, 2025. This is an interesting strat for someone who has US dollars and they would like, and when I say by cash secured, I mean you're not using any leverage. Yeah. You have $2,200 US dollars and you're using that as collateral to sell a put option for 1 Ether, just for simple math. So you have enough cash in your account to pay for the obligation of being short the 2,200 strike March 28th Ethereum put option. All right. What are the risks to this strat? Well, number one, the risks are, of course, Ether can end up at a lower price than the strike price at expiry, and you're obligated to buy Ethereum at $2,200. Now, the easy argument against that risk is that, well, I want to buy Ether anyway, and I was considering buying it today at $2,600. Yeah. Okay. The second risk to that strategy is that you don't get assigned. If Ether does not trade below at or below $2,200 on expiry, your obligation goes away and you just collect the premium you earned from selling the put option, because logically the buyer of the put option is not going to want to sell you Ether at 2,200 if Ether is above that price on the expiration date. Okay.
Sure.
Right. So we can build on this strategy just like we build on the covered call strat. We can build on the cash secured put strat by saying, okay, I'm going to sell this 2,200 strike put option. I'm going to collect premium either in dollars or in Ether. And now, since I'm nervous that maybe Ether is just going to turn around and run to 4,000 or whatever the thesis might be, you can take that premium from selling the cash secured put and you can go buy call options, the right to own Ether at the strike at the expiration date. And you're paying for that call with the premium earned from selling the cash secured put. Okay. So even if Ether, doesn't follow through with that thesis and it stays range bound, you don't have a capital outlay. You paid for that call option exposure from the premium earned by selling the cash secured put.
Yeah. That's really interesting. That's very cool.
Yeah. This is great. I think, shout out to your book. If people want to learn about more of these strategies, I have it on my desk, next in line to be read. So
yeah,
I'm excited to learn some more. I think, the cash secured put, I think it's a really cool idea.
Yeah.
So thanks for sharing that with us.
Yeah, definitely. I mean, this is what it's all about. You talked to me earlier. Why did you write the book? This is why I wrote the book. This stuff is interesting. It's fun, and it can help people not just in their digital asset portfolio, but in their entire financial market exposure portfolio. Think about how to manage risk and how to deploy cash and all this.
Yeah, definitely. That's really cool. Kind of switching gears a bit. What are your thoughts on how you're on the ETF side? What are your thoughts on the spot Bitcoin ETF and other ETFs that have come out or soon to be launched, just from your perspective?
Yeah, the ETFs are, I'll use the word critical. A critical development for these particular digital assets that they have been approved for. They're critical for the institutional adoption of the underlying assets. And what I mean by that is, as we are still in this adoption phase of digital assets and self-custody and not your keys, not your coin, and controlling your own wallets, there's a lot of people that are turned off by that thesis, that idea that I'm going to buy Bitcoin or Ether and I'm going to hold it in a wallet that only I control access to. And, there's some concerns around that. And I understand those concerns from, let's say pension funds, let's say state treasuries, potentially the federal government. Hopefully these entities do the homework on how to properly custody these assets, because really that's the edge in digital asset markets, is being able to hold these assets and have them under your own control. But as a mechanism for adoption, these ETFs are welcomed, I would say. And also it goes back to, many market participants can understand the idea that until you have a position on, you might do the homework, but you're not studying as hard. Right. And so now you start to think about, we've seen, college endowments buying Bitcoin, and we've seen pension funds, and now we're seeing states pass legislation to add it onto their balance sheets. And of course, the federal government's talking about it. Hopefully, the ETF is a bridge for eventual spot asset exposure. And, whether that custody is quote unquote, self-custody, or if it's done through qualified custodians with tri-party and quad party and whatever number you want to put on it, wallet rule sets, then, I'm all for it. And also, I think, this is a less of a important point, but there is a liquidity component here, because when you have spot markets, ETF markets, and then the Chicago Mercantile Exchange has a futures contract for Bitcoin that's funded with dollars. All these markets, they create spreads where, I can be long spot, short the ETF, or I can be long spot, short the future. Okay. These spread markets provide opportunities for professional traders to build out liquidity. And that probably is just a net positive for the ecosystem.
100%.
But
any
regular stuff, study, not your keys, not your coin.
Yeah.
Very important.
A lesson some of us are still learning. From a broader crypto perspective, John, what excites you the most in the industry? Any particular sectors or whatever you want to call it?
I mean, look, 2025. We've just had this massive event in United States politics where the current president of the country has launched a token. They've tokenized themselves, the Trump coin, right? And the first lady has tokenized herself with the Melania token. The writing is on the wall for anyone who wants to open their eyes, that the tokenization of real world assets and also humanness is at our doorsteps. And we're about to undergo another part of this technical revolution that we have been experiencing since the dawn of the personal computer. And then of course the internet and web, web 1, then to web 2, and, now what we call web 3. So I am not going to comment on my thoughts on Trump coin or Melania coin, but I am going to comment that for those paying attention, tokenization is here. And you start to think about, I'll pivot into the tokenization of real world assets like real estate. Tokenization of real estate will allow for investors to buy $1,000 worth of a commercial building, for example. They will allow for investors to buy, fractions of basically any type of real estate. And that's an example of democratization of markets, where, these real estate deals that might have only been available to the most plugged in, sophisticated, and well-capitalized investors 5, 10, 100 years, 1,000 years ago. Now, from this point forward, there's going to be a marketplace for, more modest investors to take positions in these assets. The other thing I'll comment on is, there's a project right now, and I'm not going to say it because you can Google it and find it, but there's a project right now that is basically recreating what Google Maps has created. And they are incentivizing people to drive around every road on the world and map it out they're actually sending physical cameras to drivers and having drivers map the world again, except they're incentivizing this effort via a token. And that token theoretically should accrue value as the world gets mapped again, but in an open source sense. You know, Google controls Google Maps, but if we can incentivize other humans to put technology to work in an open source manner and go collect mapping data and incentivize them by paying them a token that should appreciate in value based on the collective effort of that network. Now you can just see where this is all going. You know, basically anything can, and that's a very broad way to say it, but anything can be tokenized, and it'll be fascinating. It'd be foolish to think that we know the limits of this technology. It'd be trying to speculate on where the internet goes in 1995.
Yeah.
So that's super exciting to me. And then I can take this all the way to like the opportunity for universal basic income. Okay. And what I mean by that is, you know, just think about the scenario I just told you about in terms of mapping the world and incentivizing individuals to go do the work and then compensate them for that work. That's just human beings putting their time, energy, and effort to work and getting compensated in real time for it. Mm-hmm. You think about websites like Facebook, Instagram, X, they monetize your attention. Okay. Your humanness is being monetized without the opportunity for you to participate.
Yeah.
But based on what I'm talking about here, I think we can all start to see that attention monetization is coming. And there is a value to simply existing on this planet as a human being. And we have really not had the technology to unlock that intrinsic human value until now.
Yeah.
So the next couple of years, people's minds are going to get blown away by the revenue opportunities that can be generated from attention and from, you know, basic effort in the world. And that sets up real conversations around universal basic income, which would be a tremendous accomplishment for this technology.
Yeah, that's really exciting to think about, being able to harness or participate and monetize one's own data set, if you will.
Mm-hmm.
You said that's actually a huge thing, which is pretty exciting to think about.
Yeah. These are some good good. I like what you brought up here. These are interesting things to think about. I mean, obviously we've talked tokenization to death. You know, it's still exciting, but the idea of I mean, I think the Google Maps is really cool. I think there's a lot of DePIN or, you know, decentralized physical infrastructure projects out there that are definitely worth looking at. It's definitely early on that front too, but yeah, glad you brought that up. Some super cool opportunities there.
Also, like mesh networking the internet. You know, if I have a node like a cell phone or a router, and I'm willing to share that internet pipe, I can monetize that. And you start to think about these old world structures, these very centralized infrastructure projects that have funneled all the value away from the user base straight to the top. Those models are about to get flipped on their head, and that's a reason to be excited.
Absolutely.
Exciting times. Yeah, for sure.
And your viewers are lucky that you're hammering this tokenization point, because I'm worried that a lot of people won't quite get it in time, and we got to keep talking about this stuff, because again, you know, how many people, you know, it's before my time, but how many people look back on that 90s internet revolution and might not have participated the way they thought they would have? Well, let's make sure we really keep talking about this stuff, because not to be cliche, but this is power to the people.
Yeah, totally agree.
100%. Yeah, I'm glad you brought that up. Yeah, that'd be cool. Yeah, maybe Skylar, maybe we could put together like lists of tokens, things like that. Different episode, but yeah, I love it, John.
Yeah, very exciting.
Cool. John, any final words as we start to wind things down here? Any thoughts you want to leave our viewers with?
The point to get across from my conversation is when you think about risk, you want to think about it in a term that where you're managing risk and not leveraging risk. And options contracts were created, invented to manage risk, not to speculate. There are certainly reasons to think about using options in a speculative manner, but the juice and the real value in understanding these contracts is to be applied in a manner that mitigates risk and does not compound it.
Yeah.
That would be my big point to wrap things up.
Yeah.
Awesome.
I love it.
Very cool.
Awesome. John, this has been a lot of fun. Where could people go to connect with you, learn more about BlockFills, and also just, quick plug, tell us a little bit about BlockFills and, who you guys work with.
Yeah, sure. So BlockFills, BlockFills.com. We are an institutional liquidity provider and market maker. We serve Bitcoin miners. We serve proprietary traders, hedge funds, asset managers, high net worth individuals, family offices, endowments, and, what's becoming more clear is some of these higher level institutions like pension funds and state treasuries, et cetera. We serve these clientele because we have access to extremely deep liquidity, a team that is, leading the way from TradFi over to crypto. And, the service here is just, it's phenomenal. There's a reason I'm at BlockFills. If you're looking to be involved in these markets, this team is going to lead you the right way. And then for myself personally, johndevine.com, johndevine.io. You can find me on X at I am John Devine. I'm also on LinkedIn, and that's the best place to catch me.
Name your book one more time too.
Yeah. So Bitcoin Options, I'll put it up there. It's on Amazon. Go check it out. And if you're ever running around these, I'm at a lot of these conferences. If you're at any of these events, feel free to look me up.
That's amazing. Well, this has been fun, John. We'll make sure to include all that in the show notes. Also link to your book as well.